Ruth, I am going to be honest. I am scared. The S&P 500 is down 9% from its peak. It just broke the 200-day moving average, which every financial commentator says is a terrible sign. Oil prices are at a multi-year high because of the Iran conflict. Ken Griffin, the guy who runs Citadel, one of the most successful hedge funds in history, just said he sees a real risk of recession. Jerome Powell is warning about economic uncertainty. And stock market crash 2026 is trending everywhere I look. I have been dollar cost averaging for 3 years. I have not sold a single share. But right now, every part of my brain is telling me to sell everything and sit in cash until this is over. Should I?
Patrick, I want you to do something for me. I want you to take that fear, that exact feeling you just described, and hold on to it. Because that feeling is the most important data point in this entire episode. Not the S&P, not oil prices, not Ken Griffin, your fear. Because I have spent the last week going through every major military conflict since 1940. World War II, Korea, Vietnam, the Gulf War, September 11th, Iraq, the Crimea annexation, and now Iran. And the data tells a story that your fear does not want you to hear. In every single case, every single one, the market recovered. And in most cases, it recovered faster than anyone expected. I call it the conflict recovery curve. And by the end of this episode, you will know exactly what that curve looks like, how long recoveries actually take, and what the data says you should do with your portfolio right now.
Every single case? Even World War II?
Even World War II. Let me walk you through it. The conflict recovery curve has 3 phases. Phase 1, the shock drop. The first days and weeks when the market prices in maximum fear. Phase 2, the uncertainty plateau. The grinding sideways period where volatility stays high and headlines alternate between worst is over and worst is yet to come. And Phase 3, the recovery surge. When the market corrects the overshoot and rewards the investors who did nothing.
Okay, start with Phase 1, the shock drop. How bad does it usually get?
Let me take you through the data conflict by conflict. Pearl Harbor, December 1941. The Dow dropped 6.5% in 2 trading days. The Korean War, June 1950. The S&P 500 dropped about 12% in the first 3 weeks. The Cuban Missile Crisis, October 1962. The closest the world has ever come to nuclear war. The S&P dropped 6.5% in 8 days.
Wait, the Cuban Missile Crisis. We were literally on the brink of nuclear war and the market only dropped 6.5%?
6.5%. And it recovered within weeks. Let me keep going. The Gulf War, August 1990. Iraq invades Kuwait. The S&P dropped 16.9% from the July peak to the October low. September 11th, 2001. The S&P dropped 11.6% in the first week of trading after markets reopened. The Iraq invasion, March 2003. The S&P had already dropped 33% from the 2000 peak, and the war compounded an existing bear market. Russia-Ukraine, early 2022. The S&P dropped about 13%, though that was combined with inflation and rate hike fears. And now Iran, 2026. The S&P is down 9% from its peak, and it has broken the 200-day moving average.
So the drop we are seeing right now, 9%, that is actually in the normal range?
It is textbook Phase 1. The shock drop averages 5 to 15% across every conflict since 1940. We are right in the middle of the historical range. And here is the key insight. The market is not calculating economic damage right now. It is pricing in maximum uncertainty. Those are 2 very different things.
Pricing in uncertainty versus calculating damage. Can you explain that difference?
When a conflict starts, nobody knows how bad it will get. Will it escalate? Will it spread? Will it crash the global economy? The market does not wait for answers. It prices in the worst-case scenario immediately. That is the shock drop. But the worst case almost never happens. And as reality replaces fear, the market corrects. That correction is phase 3, the recovery surge. But between the shock drop and the recovery surge, there is the hardest part.
Phase 2. The uncertainty plateau.
The uncertainty plateau is where the market stops falling but does not recover. It moves sideways. Volatility stays high. Headlines alternate between worst is over and worst is yet to come. And psychologically, this is actually harder than the shock drop.
Harder than the crash itself? How?
The shock drop has adrenaline. It is crisis mode. Fight or flight. You feel something and you react. The plateau is just grinding uncertainty. No resolution, no direction. Just waiting. And as we talked about in our episode on loss aversion, the pain of losses is felt about twice as intensely as the pleasure of gains. During the plateau, you are sitting with that pain every single day. And that is where most investors make their second mistake.
The second mistake. So the first mistake is panic selling during the shock drop. What is the second?
They survived the shock drop without selling. They held on through the worst days. But the grinding uncertainty of the plateau wears them down. They sell at the bottom, not because of a single bad day, but because of weeks of not knowing. During the Gulf War, the plateau lasted from August to October 1990, about 3 months. During September 11th, it lasted about 2 months. During the Iraq invasion, about 2 months. During Russia, Ukraine in 2022, it lasted about 4 months. The plateau always ends, but it does not feel like it will while you are in it.
2 to 4 months. That is a long time to sit with that kind of uncertainty.
It is, and that is exactly why the plateau is the buying opportunity. Not because the war is over, but because the market has already priced in the worst-case scenario. The investors who bought during the plateau, or simply kept dollar-cost averaging through it, are the ones who benefited most from Phase 3.
Phase 3. The recovery surge. Okay, this is the part I need to hear. What does the recovery actually look like?
Let me give you the numbers. Pearl Harbor. 12 months after the attack, the market was positive, up about 15% from the low. The Korean War. 12 months later, the S&P was up 29%. The Cuban Missile Crisis. 12 months later, up 33%. The Gulf War. 12 months after the October 1990 low, the S&P was up 33%. September 11th, 12 months after the September 2001 low, the S&P was up 22%. The Iraq invasion. 12 months after the March 2003 low, up 35%. Russia-Ukraine. 12 months after the October 2022 low, up about 15%.
Every single time?
Every single time. The average 12-month return after the conflict low is approximately 25%. Not because wars are good for stocks, but because the shock drop overshoots the actual economic damage, and the recovery surge corrects that overshoot. The recovery surge rewards the investors who did nothing. Not the ones who predicted the bottom. Not the ones who timed the recovery. The ones who simply did not sell.
25% average recovery in 12 months. That is incredible. But Ruth, this time there is an oil shock. Oil is at a multi-year high. Does that change the pattern?
Oil shocks are the most feared economic weapon in geopolitics. And the fear is always worse than the reality. Let me give you 3 examples. The 1973 Arab oil embargo. Oil prices quadrupled. The S&P dropped 48%. But that was combined with Nixon, Watergate, and an existing recession. And even then, the S&P doubled in the next 2 years. The 1990 Gulf War oil spike. Oil went from $17 to $41 per barrel. The S&P dropped 16.9%. Recovery? Up 33% in 12 months. The 2022 Russia-Ukraine oil spike. Oil hit $130 per barrel. The S&P dropped 25%, combined with inflation and rate hikes. Recovery? Up 15% in 12 months from the low.
So even with oil shocks, the recovery still happened.
Every time. And here is something most people do not realize. The United States economy is far less oil-dependent than it was in 1973. Energy is 4% of the S&P 500 today, versus 28% in 1980. The economy has structurally decoupled from oil price spikes. Oil shocks create headlines. But the actual economic damage is a fraction of what it was 40 years ago. The fear of an oil shock is almost always worse than the oil shock itself.
4% versus 28%. I had no idea the economy had shifted that much. Okay, so the oil shock fear is overblown. But there is another thing I keep hearing. People are saying this is a midterm election year and those are always volatile. Is that true?
It is true. And this is something most investors do not know. Even without a war, midterm election years are historically the most volatile years in the presidential cycle. Ned Davis research shows that midterm years have a 50-50 chance of a 19% or greater drawdown. The average midterm year intra-year decline is about 17%.
Wait, 50-50, chance of a 19% drop? Just because it is a midterm year?
Statistically, yes. But here is the critical part. The average 12-month return from the midterm year low is approximately 32%. So midterm years drop hard, but they recover even harder. The pattern has held every time since 1950.
So even if there was no Iran conflict, we would still expect a significant drawdown this year?
Statistically, yes. The Iran conflict is adding fear on top of a year that was already likely to be volatile. But both patterns point to the same conclusion. The current drop is not just a war story. It is a war story layered on top of a midterm year story. And both patterns say the same thing. The recovery comes.
Okay, so we have the conflict recovery curve. 3 phases: the shock drop, the uncertainty plateau, the recovery surge. We have the oil shock data showing the economy is way less oil dependent than people think. We have the midterm year data showing this kind of volatility is actually normal. Now the big question: what do I actually do with my portfolio?
Let me give you 4 actions. Not opinions. Actions backed by 86 years of data.
Give me the 4.
Action 1. Do not sell. In 86 years and 8 major conflicts, panic selling during the shock drop or the uncertainty plateau has been the wrong move every single time. Not most of the time. Every time. The investors who sold during Phase 1 of any conflict since 1940 locked in losses that the market erased within months. Action 2. Continue dollar cost averaging. If you are investing a fixed amount every month, this is the month your money buys more shares at lower prices. That is not a platitude. That is math. The shares you buy during Phase 1 and Phase 2 are the shares that benefit most from Phase 3.
So the money I invest this month, while everything feels terrible, is actually the money that benefits the most from the recovery.
That is exactly right. Action 3. Check your allocation, not the headlines. If your portfolio was properly allocated before the conflict, it is still properly allocated. Wars do not change your time horizon. They do not change your risk tolerance. They change your emotions. And your emotions are not a valid investment thesis.
Your emotions are not a valid investment thesis. That is a line I need to write down.
Action 4. Remember the base rate. The S&P 500 has returned an average of approximately 10% per year for the last 100 years. That includes 2 world wars, Korea, Vietnam, the Gulf War, September 11th, Iraq, the 2008 financial crisis, COVID, and now Iran. The base rate includes the wars. The wars are already in the number.
The wars are already in the number. That is the line I needed to hear. The 10% average is not a peacetime number. It is an all-weather number. It already includes the worst moments in modern history.
Exactly. Your portfolio does not need peace to grow. It does not need certainty. It does not need calm headlines. It needs one thing: time.
Okay, let me bring it all together. Let me recap what we covered today. Number 1. The conflict recovery curve has 3 phases. The shock drop, where the market prices in maximum fear. The uncertainty plateau, the grinding sideways period that wears investors down. And the recovery surge, where the market corrects the overshoot and rewards the investors who did nothing. This pattern has repeated across every major military conflict since 1940. Number 2. The current 9% drop is textbook Phase 1. The shock drop averages 5 to 15%. We are right in the middle of the historical range. The market is pricing in maximum uncertainty, not calculating actual economic damage. Number 3. The average 12-month return after the conflict low is approximately 25%. In every single conflict since 1940, the market recovered. Panic selling during wars has been the wrong move every single time. Number 4. Oil shocks create fear that exceeds the actual economic damage. Energy is 4% of the S&P 500 today versus 28% in 1980. And midterm election years already carry a 50-50 chance of a 19% drawdown regardless of geopolitics. Both patterns point to recovery. And number 5. The S&P 500 has returned approximately 10% per year for the last 100 years. That number includes every war, every crash, every crisis. The wars are already in the number. Do not sell. Keep dollar cost averaging. Check your allocation, not the headlines. And remember, your emotions are not a valid investment thesis.
Patrick, let me close with this. We are in Phase 1 right now. The S&P is down 9%. Oil is elevated. The headlines are terrifying. And the data from 86 years and 8 major conflicts says the same thing every time. The recovery comes, not because wars end quickly, not because the economy is immune, but because markets overshoot on fear and correct on reality.
So the answer to my question, should I sell everything?
The answer is the same answer it has been for 86 years. No, stay invested. Keep dollar cost averaging. Check your allocation, not the headlines. And remember, the wars are already in the number. Build wealth with patience, not panic.
Follow calm investors wherever you are listening.